Great. Thanks for joining us again here. I know it's a beautiful day out there, so it's tempting to be outdoors, not inside. We're going to jump into a discussion of asset allocation, passive versus active, as well as where the hedge funds fit within that context. And we're very pleased to have some introductory remarks from Gemma Godfrey, who is the head of research and chairman of the investment committee for Credo Capital. She's also a quantum physicist by training, so that means that she can explain what was intended to be a layman's book, Stephen Hawking's Brief History of Time, which she can actually explain it to me. So please join me in welcoming Gemma.
Well, thank you very much for coming today to listen to this panel discussion. We're here to discuss justifying the smart hedge fund manager. Is best of breed fund management still enough for the modern investor, and how do active strategies and smart fund managers add value to the portfolios? So, as the introduction said, who am I? I'm chairman of the investment committee, head of research at Credo. Interestingly enough, so at the moment I'm an allocator, but I used to be a hedge fund manager, so I've sat on both sides of the table. Which means that in addition to actually all the investments that I invest in, all the funds that I go for are actually external. It means I'm an objective asset allocator, and I look for opportunities and also I'm wary of risks. So what am I saying today? First of all, best of breed, it seems to be a dying breed. Secondly, strategy choice does matter. And thirdly, active strategies and smart fund managers do have a place to add value to portfolios. So first of all, why is best of breed fund management a dying breed? And here I'm talking about the fund of funds structure, and in particular, because obviously fund of funds can add value to a portfolio, I'm talking about the ones that go out there and will just pick the best funds around. Fundamentally, one of the biggest problems that hedge funds made was the use of the term, too free use of the term absolute return, as well as calling themselves masters of the universe, which kind of set themselves up for quite a big fall. And as we can see from the graph at the bottom, which is in orange, you can see the performance of hedge funds, or the average hedge fund index, and then in yellow and in white against the world index and bond markets, and you can see obviously a very sharp correction, as we all know, in 2008. Secondly, bigger isn't always better. So again, there was this perception of as long as you invest in the larger funds, you'll be safe. So the fund of funds out there would go and find the star fund managers of the time and be investing in them. However, as 2008 showed us, the biggest funds were the ones that had quite often liquidity problems to actually liquidate their positions, and the side pockets and the gates that they implemented obviously burned bridges with investors. And finally, we saw a due diligence downfall. So again, fund of funds were very much relied upon to do due diligence for investors, and they were outsourcing their hedge fund investment to these structures, hoping that they would do the appropriate amount of due diligence. But unfortunately, a lot of fund of funds out there invest in Madoff, etc., and have significant exposure. So that was the first point, which was to do with the fact that managers have had to get smarter. And this second point is that there is no such thing as a typical hedge fund. And we've heard a lot about this today anyway, about how it's not necessarily an asset class, potentially it's more about a strategy, and you can put hedge funds into different buckets. And this is a quote from the Hedge Fund Association, which, as we're quite aware, you've got a variety of hedge fund returns, a variety of volatility, and amount of risk that hedge funds implement. What this means is, the index that I showed you before, it's an artificial averaging of the performance of a wide variety of instruments. And if there's one image you take away, it's actually this image. I'm not sure how well it comes up for you to see. What it shows is, in orange you've got the world index, in white you've got this averaging, but actually in all the variety of colours you can see different strategies and how they perform. You can clearly see that at different times different strategies perform very well and different strategies are losing money. And the data that I'd emphasise here is that over the last 3 years, the best performing strategy has outperformed the worst performing strategy by 130%. So just investing in a hedge fund wouldn't have done it. And I'm sure this chart many of you are very familiar with. This also gives you an overview that not only over a 3-year time horizon, but from year to year, it's very important to get the strategy choice right. It's just, what you can see from going left to right is different years, and they rank the performance of different strategies, which are in different colours. And as you can see from the patchwork, the fact there's very little pattern going from left to right, year to year, the ranking changes dramatically. So investors, what about on the investor side? We've heard about how they've let them down, but what about on the investor side? They're actually calling for more for their money. And what this shows is we've seen a reversal of the substantial outflows. In 2008, we had $782 billion flowing out of the hedge fund industry. And actually last year, we did see a return of assets return of capital into hedge funds. But as you can see from this chart, it was very strategy specific. We saw managed futures and also managed futures and multi-strat still bleeding capital, but long-short tends to return to favour. And if we just think about that asset class, a lot of reason, anecdotally, we also did this ourselves at Credo, is we viewed, clients have been burned by the word hedge funds. Clients understand long-only funds. If we can say, there's a long-only equity fund, they just trade equities, but they also have the potential to protect your capital, i.e. long-short funds, let's put it into our equity bucket and it'll help kind of tweak the timing when markets are a bit more rough. So it was an easier sell, clients understood it better, it seemed a little bit more traditional, so that's probably why we saw significant inflow into long-short managers. So in the post-crisis era, we're seeing a call for an increase of transparency, simplicity and liquidity, which means that fund of funds are fighting for this extra layer of fees that they charge. And the final point to make is the fact that active managers do have a place in our portfolios to do with the environment and also the tools that they have available to them. So if we look at the actual macro environment at the moment, there's this lack of clarity with the risk of macro shocks, and I'll just highlight this with a few cartoons. This was actually Bush, you can swap Bush for Obama, and this has him, there he is trying very hard to find some stability. This is a cartoon about Libya, and what it's saying is that Libya is actually providing such little oil to the global oil supply, it's really an excuse for keeping prices high. And then the third one is obviously about the IMF and the ex-head of the IMF phoning up the IMF themselves and needing his own bail out of jail. So these cartoons kind of show the risks that are out there. Secondly, there's heightened amount of correlation. So active managers very much can focus on providing diversified returns. And if I show you this chart, and again, I'm sure that you're quite familiar that if you look at the equity markets and also the commodity markets, they've been trading very much in line very recently. And the reason for this is, you've got an increase of speculators in the market and they're trading it as a risk asset. So they're trading equities as a risk asset, commodities as a risk asset, so they're moving in line. So in this type of environment where people used to use commodities to diversify their portfolio, they're now having to look elsewhere. And finally, also, it's been a high beta rally. So again, this very interesting chart on the left shows that if we look from the trough of the markets up until very recently, it's the consumer discretionary names that have been driving the returns in the markets, and consumer staples, who you'd think, if you look at the consumer discretionary names, they're the ones that should have demand hit most in a recession when people are pulling back on their spending, and actually it's consumer staples, food, they're providing the staples that consumers will need that have a more protected demand base, and yet they haven't participated in the upside as much. So in this type of environment where it's been a high beta rally, and the chart on the right shows that correlations between stocks is actually falling, it's a good opportunity for managers that can go in and pick the winners from the losers. So what have I said? Best of breed is a dying breed. Strategy choice does matter, and active strategies and smart fund managers are able to add value. So what can you do? First of all, be strategic. So utilise your top-down views to pick the right strategies. Secondly, be sensible and ensure the fees are deserved. So giving you more than just an access to good funds, but giving you something to compensate for the fees and also sometimes tying up your capital for longer. Focusing on portfolio construction and maybe generating returns from niche opportunities. And also ensuring that that the redemption frequency matches the liquidity of the underlying investments, because there's both a part in your portfolio for liquid investments and illiquid investments as long as they're appropriate. And finally, speak up. And this is very much the case both from an investor perspective and also a hedge fund perspective, to manage expectations. so that hedge funds aren't shocked by redemptions from the investors, and investors aren't shocked by tie-ups and gates, etc. So I think we'll move on to the panel now. Thank you very much.